Two Nvidia income funds walk into the operating room flashing yields above 40%. One bets against Nvidia. The other reaches for twice Nvidia's daily move. Both pay weekly. Both sell options. And both have lost more than half their net asset value since launch. That is not a minor footnote. It is the whole autopsy. DIPS advertises a 40% distribution yield while trying to deliver inverse exposure to Nvidia. NVYY advertises 43% while seeking daily 2 times exposure to Nvidia. These are not two versions of the same income idea. They are opposing directional machines strapped to premium harvesting engines. One wants the stock down. The other wants the stock up, with leverage. Yet the headline payout can make both look like interchangeable cash fountains. They are not. Today we are separating income from illusion. Which fund paid more? Which preserved more capital, which produced the better all-in result, and what each one quietly asks you to sacrifice for that weekly deposit. Because a yield can look like a paycheck even while the account underneath it is being dismantled for parts. In one corner is the Yield Max Short NVDA Option Income Strategy ETF, ticker DIPS, issued by Yield Max and launched on July 23, 2024. It has $7 million in assets and charges a 1% expense ratio. DIPS is the contrarian of this matchup. It seeks current income plus inverse exposure to Nvidia, ticker NVDA. In plain English, it is built to lean against Nvidia rather than ride with it. But DIPS does not simply borrow Nvidia shares and short them. Its reported holdings are mostly the plumbing behind an options strategy. United States Treasury bills at 96%, United States Treasury notes at 14%, a cash offset at 6%, and First American Government obligs X, ticker FGXXX, at 2%. It also writes 2 put options for premium income. Those Treasury positions are collateral, the financial sandbags supporting the derivative structure, not evidence that this is a sleepy government bond fund. The machine works like this. DIPS uses an actively managed synthetic covered put strategy to create inverse Nvidia exposure without treating Nvidia stock itself as the core holding. The inverse side is supposed to benefit when Nvidia falls. The written puts collect premium, which helps manufacture the weekly distribution. But selling those puts also gives away part of what would otherwise be the attractive side of a bearish trade. If Nvidia drops, the inverse exposure may help, while the short puts become more costly and can blunt the benefit. If Nvidia surges, the inverse exposure is the wrong way bet. DIPS is therefore not a clean Nvidia short with free income attached. It is a bearish options package that rents out part of its favorable payoff in exchange for cash today. In the other corner is the Granite Shares Yield Boost NVDA ETF, ticker NVYY, issued by Granite Shares and launched on May 12, 2025. It has $31 million in assets and charges 1%. NVYY seeks current income plus daily 2 times leverage to Nvidia's price performance. This machine is pointed in the opposite direction. It wants an amplified version of Nvidia's daily move, then tries to pull option premium from that high-octane exposure. Its reported holdings include US dollars at 41%, United States Treasury bills at 45%, and cash equivalents at 14%. It also writes 6 put options for premium income and holds other ETFs designed to pursue leveraged Nvidia exposure. Again, the cash and treasury pile is support equipment. The economic engine is the combination of leveraged Nvidia exposure and written puts. The daily 2 times target matters. It is a daily objective, not a promise that a long-term holder receives exactly twice Nvidia's return over an entire holding period. The fund resets its exposure as the market moves. In a clean, persistent rise, leverage can be a strong tailwind. In a choppy path, repeated resetting can create drag even if Nvidia eventually ends near where it began. Meanwhile, selling puts brings in premium but leaves the fund exposed when Nvidia falls. That means NVYY can be hit by both the leveraged directional move and the option obligation during a hard sell-off, so the strategic split is stark. DIPS is a bearish income trade that can suffer when Nvidia rallies and can cap part of its reward when Nvidia falls. NVYY is a leveraged bullish income trade that can suffer disproportionately when Nvidia falls and can be worn down by volatility along the way. DIPS writes 2 puts around an inverse package. NVYY writes 6 around a daily leveraged package. Same celebrity stock, same category of derivative income, completely different directional wager. Before we examine the payouts, this is research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold DIPS, NVYY, or any other security. ETFs can lose value, and options-based and leverage strategies can behave very differently from their headline objectives over time. Verify the current fund prospectus, holdings, distribution notices, tax information, and other official fund documents yourself, because strategies and figures can change. Consult a qualified financial, investment, tax, or legal professional who understands your circumstances before making any decision. Now to the billboard numbers. DIPS shows a 40% headline distribution yield. NVYY shows 43%. Both pay weekly. On the surface, NVYY wins the yield contest. But that is like judging 2 engines by the size of the exhaust flame. It tells you something dramatic is happening. It does not tell you whether the vehicle is moving forward. A distribution yield is not the same thing as an earned return. Option premium can support a payment, but a fund can also distribute cash while its capital base falls. Depending on the fund's accounting and tax treatment, some of what reaches the holder may be income, gains, or return of capital. Return of capital is not automatically sinister. It can be part of an options fund's distribution mechanics. But when large cash payments arrive beside severe loss of fund value, the holder must ask whether the fund is generating wealth or merely changing wealth from share value into spendable cash. DIPS has paid $92.96 per share in cash distributions since launch. That is an eye-catching pile of cash beside a fund that began from a much higher reference price. NVYY has paid $21.47 per share since its later launch. Comparing those raw totals without the different launch dates and starting prices would be sloppy. DIPS has existed longer and began at a far higher price, so its larger cumulative payment does not prove that its machine was healthier. The weekly schedule adds another psychological wrinkle. Frequent deposits feel productive because the evidence keeps arriving in the account, but payment frequency does not improve the economics by itself. Weekly slicing can make an unstable payout look like a salary, even though every distribution reduces the fund's assets when it leaves. What matters is whether the strategy replenishes that outgoing cash through investment performance and option premium without consuming the capital base faster than it can recover. NVYY's slightly higher headline rate therefore earns only the narrowest victory. Its advertised yield is higher. DIPS has delivered more cumulative dollars per share, but from a different starting point and over a longer life. Neither fact answers the real question. For that, we have to inspect what happened to the share value after all those payments left the building. Net asset value is where the bedside monitor starts beeping. DIPS has a launch reference price of $207.40 and a latest NAV of $34.77. Its NAV return since inception is negative 83%. That means the quoted fund value did not merely sag while paying income. Most of the original capital base disappeared from the NAV path. A holder who focused only on weekly deposits could miss that the container producing those deposits became dramatically smaller. The direction of Nvidia matters here because DIPS is built around inverse exposure. A powerful rise in Nvidia is hostile terrain for a bearish package. The option income overlay does not repeal that directional reality. Premium can cushion some damage, but it cannot guarantee preservation when the core wager is repeatedly on the wrong side. And because the fund sells part of the payoff through written puts, even favorable bearish periods do not behave like an unlimited clean short. The NAV path is the cumulative receipt for that asymmetry. NVYY began from a $25.69 reference price and now has a latest NAV of $11.77. Its NAV return since inception is negative 54%. That is also severe capital loss. The fund needs to manage daily leverage, volatile Nvidia exposure, option positions, and weekly cash leaving the portfolio. When the path is rough, those forces can pull in the same unpleasant direction. Daily leverage magnifies moves, path dependence can create friction, and distributions reduce the asset pool unless performance replaces them. Head-to-head, NVYY held up better on NAV. Losing 54% is materially less destructive than losing 83%. That does not make NVYY's price path healthy. It makes it the less damaged of two heavily damaged capital bases. DIPS ended with a little under 1/5 of its launch reference value still represented in NAV, while NVYY retained closer to half. The exact comparison matters because both yield figures sit above 40%, but the capital outcomes underneath them are not equal. This is the moment an income investor should stop treating price decline as somebody else's problem. A lower NAV means fewer dollars remain inside the fund to participate in recovery and support future option trades. It can also make a stable per-share payment harder to maintain. An options ETF may execute its stated strategy exactly as designed and still produce an unattractive NAV journey. Strategy compliance is not the same thing as investor success. NAV alone is not the complete verdict, because these funds deliberately send cash out. Ignoring distributions would grade an income product while throwing away the income. The fairer first-pass question is simple. If we add the cash distributions back to the ending value, did the holder come out ahead or behind? For DIPS, the simple distribution-inclusive return since launch is negative 38%. So even after giving the fund full credit for every recorded cash distribution, the result remains a substantial loss. The weekly payments soften the damage compared with the NAV decline, but they did not rescue the investment. This is the mathematical difference between receiving cash and creating return. DIPS sent a great deal of money across the table, yet the combined pile of remaining fund value and prior distributions was still smaller than the starting stake. NVYY tells a more complicated story. Its simple distribution-inclusive return since launch is 29%. After adding the distributions to the latest fund value, the basic calculation is positive despite the damaged NAV. That is an important credit, and it is why these two funds should not be flattened into the same disaster narrative. NVYY's capital base has been hit hard, but the cash paid so far has more than offset that loss in this simple calculation. Head-to-head, NVYY wins the all-in result decisively, positive 29% against negative 38%. The difference is not cosmetic. DIPS failed to make its holder whole after distributions. NVYY so far did more than make the holder whole under this simplified method. But simple deserves emphasis. This calculation does not tell every investor's lived result. Purchase timing, sale timing, taxes, reinvestment prices, bid-ask spreads, and whether distributions were spent or reinvested can all change the experience. It also is not an annualized return and should not be treated as one. The two funds launched on different dates, so the figures describe each fund's own life rather than an equal-length race. Still, the core lesson survives those caveats. A falling NAV does not automatically mean an income fund produced a negative all-in result, as NVYY demonstrates. And a spectacular stream of cash does not automatically overcome capital destruction, as DIPS demonstrates. Total return is where the weekly theater meets the final bill. Risk is not just how far a fund fell. It is also whether the payout engine appears to be losing pressure while the fund is down. DIPS recorded a max drawdown of negative 85%. NVYY's max drawdown was negative 58%. NVYY therefore suffered the smaller peak-to-trough loss. DIPS came perilously close to erasing its entire prior peak value, while NVYY's decline was still brutal but less extreme. For a holder, drawdown is not an abstract statistic. It measures the depth of the hole from which capital must climb, and losses become harder to recover from as they deepen. The directional designs create different failure modes. DIPS is vulnerable to a sustained Nvidia advance because its inverse stance keeps fighting the underlying trend. Yet a sharp Nvidia decline is not a perfect escape hatch, because the written puts can become liabilities and trim the benefit from being bearish. Its danger is structural frustration, pain when the stock rises, with part of the reward surrendered when the stock falls. NVYY is vulnerable to violent declines, sideways turbulence, and the mechanics of daily leverage. A sharp drop can hurt the leveraged exposure and the sold puts together. A whipsawing market can also punish repeated daily resets. Its danger is amplification. It asks a volatile stock to produce enough favorable movement and premium to overcome leverage drag, option losses, expenses, and outgoing distributions. Now inspect the distribution trend. DIPS averaged 788 cents per share across its first 4 distributions. Its latest 4 averaged just 27 cents. The latest average is 3% of the first average. That payout has fallen dramatically. The headline yield may still look enormous because yield is measured against a much lower fund value, but the per-share cash stream is nowhere near its opening level. NVYY averaged 60 cents per share across its first 4 distributions and 10 cents across its latest 4. Its latest average is 16% of the first average. That payout has also fallen sharply. Give NVYY the comparative credit. Retaining 16% of the opening average is better than retaining 3%. But the drop is still a serious deterioration in the cash stream a holder actually receives per share. That combination creates the central risk in both funds. A lower fund value can make the quoted yield look sensational at the same time the per-share distribution is being cut. The percentage can remain loud while the dollars and cents grow quiet. DIPS shows the more severe version, with the deeper drawdown and weaker payout retention. NVYY shows a less catastrophic but still unstable version, where a positive all-in result so far coexists with major damage to both capital and payment level. The assigned verdict for DIPS is cause of death, NAV erosion. That label is earned by the combination of a negative 38% distribution-inclusive return and negative 83% NAV return, and a latest distribution average equal to only 3% of its first average. DIPS did what high-yield optics often tempt investors to ignore. It delivered conspicuous cash while the economic body underneath it deteriorated. The distributions did not compensate for the capital loss, and the collapsing per-share payout left less income arriving from a much smaller base. In this autopsy, much of the apparent income was the holder's own capital coming back in another form. The assigned verdict for NVYY is on life support. That label is deliberately different. NVYY's 29% distribution-inclusive return means the machine has produced a positive simple all-in result so far, and that deserves clear credit. But its negative 54% NAV return and latest distribution average at 16% of the first average show a fund whose capital and cash output have both weakened severely. This patient is not dead, but the headline yield is doing more smiling than the underlying vital signs justify. The decisive head-to-head conclusion is that NVYY has been the stronger of these two imperfect machines. It preserved more NAV, suffered the smaller drawdown, retained more of its initial payout level, and delivered the positive simple all-in result. DIPS lost on every one of those health measures despite distributing more cumulative cash per share. That is not a recommendation to buy NVYY or sell DIPS. These are different tools for different market views and different tolerances. DIPS is a specialized bearish Nvidia income instrument whose option overlay trades away part of the clean inverse payoff. NVYY is a specialized leveraged bullish Nvidia income instrument whose daily reset and short puts can magnify damage in hostile markets. One might fit a narrowly defined tactical thesis, the other might fit a different one. Neither should be mistaken for a conventional, dependable income holding simply because it pays every week. The practical question is not, which yield is bigger? It is, what market path must this machine survive, what payoff has it sold to fund the distribution, and how much capital remains if that path goes wrong? On the evidence here, NVYY has kept the better overall scorecard, while DIPS presents the clearer case of cash flow masking capital destruction. Different tools, different goals, different failure modes, and this comparison remains research and education only. 2 quick things before you go. If this head-to-head helped you cut through the hype, hit the like button and subscribe. It is what keeps these autopsies coming. And tell us in the comments, which of these 2 would you pick and what matchup should we run next? We read everyone. Thanks for watching.